Hernandez. I'm Business Development Manager here at the Climate Action Reserve, and I want to welcome our panelists and guests on the line today for our Special Topics webinar, the California Carbon Allowance Post-Auction Roundtable. So this format's going to be a little bit different than some of our kind of normal webinars, which have a lot more slides. So I think we're giving everyone a little bit of a break, although we do have a few graphs and charts to display. And before we get started, let me just get a show of hands from the audience to make sure that the audio is coming through okay. And once I see, okay, yeah, I see some hands popping up, so I'll assume that the sound is coming in okay. So as I mentioned, we have a really great panel today. So just to give a little bit of an introduction, we have Emilie Mazzacurati, who is the Managing Director at 427 Climate Research and Consulting, and formerly at Thomson Reuters Point Carbon. Timothy O'Connor, Attorney and Director for EDF's California Climate Initiative, and EDF is the Environmental Defense Fund, not the French utility, which I think is the subject of confusion when you get into cap and trade. And then finally, we have Dave Mann, Environmental Markets Broker at TFS Energy. And the format of this panel is going to be a little bit different, so we're hoping to kind of have a real kind of wide-ranging discussion. We're going to look at kind of the auction results and kind of talk about how it went and kind of what they mean. And in doing that, before we get too deep into it, we're going to talk a little bit about the format so that everyone on the line is kind of on the same page of level of understanding of kind of what these results mean. We're going to look a little bit at the participation, who's going to get the auction revenues, and then we'll open it up to an open discussion amongst the panelists. We'll cover some of the questions that were submitted from the audience prior to the webinar, submitted online. And after that, we will open up for questions from the audience. So if you are on the line and you do have a question, feel free to type it into the question box in the webinar software. And when we do get to the Q&A, we'll go ahead and take questions from there. So with that, I will go ahead and pass it to Emilie, who's going to kind of give us a little bit of the introduction and background information, and we will get started. So let me just
Thanks, Scott.
Get your slides up here.
Thanks, Scott, and good morning, everybody. Thanks for being with us this morning. We just thought we would start with a very simple overview of what those results were, how the auction went, so that we can get the discussion started with everybody on the same page. So bear with me if you follow that every day and everything I'm going to say you're familiar with. As most of you know, and that's why you're on the call today, November 14th, California held its first auction of carbon allowances, which are also known as CCAs. And there was 23 million allowances of vintage 2013 and almost 40 million allowances of vintage 2015 that were offered for sales. And when I say vintage, I mean that they can be used for compliance either of that year or a year later. So in other words, if you buy an allowance vintage 2015, you would not be able to use it for compliance next year. So keep that in mind as we go through the results. The allowances for next year, V2013, sold, all of them. There were actually 3 times as many bids as allowances offered. But they sold at a price just barely above the price floor, the auction reserve price. So they sold for $10.09, knowing that the California Air Resources Board was not going to sell for less than $10. The vintage 2015 allowances did not sell as well. Only 14% were sold. That's 5.5 million, and they sold at the reserve price of $10. In total, that means the revenue was total revenue raised was $290 million, not an insignificant sum. And there were about 73 companies, organizations, government agencies that were approved to participate in the auction. That doesn't mean all of them actually bought anything. And I believe Tim has a little more on who the buyers are. Do you want me to go over this as well? No.
Yeah, maybe we can talk about the mechanics and then get into the market participants.
All right, so yeah, let's talk a little bit about how the auction works. So it's not your typical auction. You're not raising your hand and saying, you know, I overbid the next person. You're sitting in front of your computer. You don't know what the others are doing. It's a sealed bid, so nobody knows what the others are bidding, either before, during, or after. And it's a single round auction. That means you only get to bid once, but you can bid several bids at once. You bid what's called a curve. So if you look at the little box to the right side of the slide, a bid curve means you can bid different quantities at different prices. So you can say, well, at a price of $10, $10.05, I want to buy 10,000 allowances. But if it's $15, I will only buy 2,000. And so you build a curve, and all the participants putting this kind of bids together build this kind of holistic curve that I drew on the slide, and that is not an actual representation of what the bids were, because I don't know that. That's just an example of what it looks like. A few people will bid, you know, low quantity for a very high price, 50. In this case, the highest bid was $91, which is a little bit of a mystery to me. And a lot of people will bid somewhere in the range of 12, 13, going down to $10. In this case, most of the bids were around $13. As you can see, the mean was $13.75, median $12.96. So bids are secrets, and then the other important feature of this auction is that everybody pays the same price. It's called a single clearing price, and that means regardless of what you bid, everybody pays the same price as the last winning bid. And so in this case, some people paid, bid $91. A lot of people bid $13, $12, but everybody ended up paying $10.09. What this means, though, is that there were a lot of unfulfilled bids that were under that price, people that were, hoping that the clearing price would be lower.
Okay, great. Okay, so Tim, tell us a little bit about who was bidding.
Yeah, great. Thank you, and good morning to everybody, or good afternoon if you're on the East Coast or beyond. My name is Tim O'Connor. I'm a director with Environmental Defense Fund, and I manage our California Climate Initiative work. I've been focusing pretty much solely on AB 32 and cap and trade for about 5.5 years, and I just want to say thanks for letting me participate. And so we did some analysis of the auction results. The Air Resources Board had a summary of their auction results that was posted on their website shortly thereafter. They listed 73 different participants or qualified bidders. It's not necessarily true that every qualified bidder submitted an actual bid, but based on those 73 participants, or bidders, it's obvious that a majority or close to 50% of those in the bidding market were power suppliers, and then the next highest sector was oil and gas and petroleum entities. You can tell based on the screen and the graph that some of these were non-compliance entities that don't have compliance obligations under the AB 32 program, and some were compliance entities, those that do have obligations under the program. And then you see pretty much a step down from brokers and traders being the third most, and obviously none of those actually have compliance requirements in this program, followed by food processing and other manufacturing. So like I said, though, that it's not, nobody can be certain because the market rules prohibit any one particular bidder or qualified bidder from stating whether they submitted a bid or talking to other bidders about bidding or price fixing or manipulation. And so there's very tight control over the information about who actually submitted bids, and that's appropriately done to protect the market. And so this is just an analysis of those that have been approved to submit bids in this market.
Tim, that's really interesting. And thinking back about, like, the opting in, as we can see with power suppliers and some of the oil and gas, and looking back a few years ago with the Prop 23, it seems like there was a lot of folks who didn't, want to be in this program. Is there a strategy maybe to opting in early? Like, are these maybe entities that will be in beginning in compliance periods of 2 and 3, and they just want to go ahead and get allowances?
Well, I think that first and foremost, with this first auction containing 100% of the utility credits that were consigned and then required to be placed into the auction, it's no surprise that we see power suppliers and those in the power industry participating at the highest percentage rate. Second, entities obviously that are going to have compliance obligations in 2013 and then the second compliance period and beyond. I do think that the larger entities that have either trading desks or that have sought out consultants, as well as those that see the longevity of this program being something that they're going to need to take into account in their business decisions, that many of those have decided to participate at this point, and because they also do have statements from the Air Resources Board about how many credits they're going to be allocated for free, and then in February of next year, there's going to be the opportunity for more of the state-controlled credits to be auctioned off. And so I do think there is some forward thinking that's going on here. Obviously, with the brokers and traders being in this, there is some speculation, although I do believe that the ARB results showing that of the credits that were sold, 97% of those in the first compliance period did indeed go to compliance entities. I do think that what we saw was the vast majority of the credits purchased by those that are compliance entities, and it would reason to stand that based on the level of participation from the power suppliers and the fact that it's the electricity portion of the program that was consigned, probably the majority of the credits were then also purchased by those suppliers as well.
Very interesting, and I know we're going to talk a little bit more about kind of the different market participants a little bit later on. I know we have some questions about the market, but very interesting. We'll go ahead and move forward. Thanks a lot, Tim. So a little bit about the auction revenues. Emilie, did you want to continue?
Right, yeah, we got some questions ahead of the webinar on where does that money go, who gets it? And it's not a simple answer, actually, because there were different types of allowances that were for sale. Some of the allowances were issued by the state of California, owned by the state of California, and the money goes back to taxpayers or certainly to the appropriation funds. But a number of the allowances that were for sale were actually consigned by the power utilities, and the way the regulations are set up, investor-owned utilities, the famous IOUs, they receive a lot of allowances, but they have to consign all of them back, sell all of them through the auction, and then they get very specific guidelines on how they can use the money. And the reason that is they can't receive free allocation because that would create distortion on the power wholesale market. But at the same time, the regulators wanted to make sure that that money was really earmarked for ratepayers, and the best way to do that was to give the allowances and then have them sold again and have the money go back to IOUs. It's a little complex, but in the end, I think it works out. And then publicly owned utilities, the munis, they had the option of selling some of the allowances they received for free, a voluntary consignment. And so in this little table, I broke this down and I estimated how the breakdown was. And that's an estimate. I don't think CARB has given the official breakdown, but I think about half the it was broken down half and half between state-owned allowances and investor utilities-owned allowances, about 11 million each. And then there was a little bit of voluntary consignment, as far as I can tell, maybe 1.5 million. So that means the money goes to different purposes. The money that comes from the allowances that were owned by the state of California, so that's 110 million for vintage 13, and then an additional $56 million for the vintage 15 allowances. So in total, over 150, maybe $165 million. that is used, that goes to a greenhouse gas reduction fund that was established by AB 32, and the California legislature just this summer passed a bill that lays out the guidelines on how the money is going to be spent. And you have to understand that this is considered a fee, and therefore it can only be spent on very specific things. It has to be spent on actions that mitigate the reason why the fee was raised in the first time. And so in this case, we're talking about greenhouse gas reduction. There's no way this money could be used for, or in theory, really should not be used for plugging the deficit, the budget deficit, for example. So the way this was set up by the legislature, the Department of Finance, together with the Air Resources Board, will put together a 3-year investment plan that will lay out how this money can be spent towards GHG reduction, and I believe it will include climate adaptation as well, knowing that at least 25% of this must go towards disadvantaged communities or to projects located in disadvantaged communities or that help those communities. The money that goes to the IOUs, the investor-owned utilities, that is still being decided by the California Public Utility Commission, and there's a decision that, proposed decision that came out just last week that says most of this money, 85%, is going to go towards neutralizing the increase in rates due to greenhouse gas programs for ratepayers, so that's you and me, to compensate the so-called trade-exposed energy-intensive industries, so that sectors like the cement sectors, refineries to some extent, some other industries, and then small businesses. And then any money after that is going to come out as a climate dividend for all Californians across the board. But that's still being finalized at the CPUC. And then the publicly owned utilities, because they volunteer to consign to sell those allowances, they have a little more flexibility on what they do, but overall it has to benefit their customers.
Okay, great. Thanks for putting all that analysis together. That's really good, Emily. So now we will open up to some of the questions that we received in advance from the audience. So I think we already kind of covered the first one, and I appreciate Emily for kind of taking the lead on that one. But let's talk a little bit about the clearing price. So this one came in online, and it was saying, you know, at $10.09, it's just above the floor. Is this good or bad, or, you know, what does that mean? And maybe Dave, I don't know if you want to jump in on this. This is kind of a market question.
Sure. I think that we can attribute this to, you know, it's early in the program. It's both early in the program in that this was the first auction that we saw. Folks kind of proceeded cautiously, at least with the pricing they showed. We could discuss the volumes for which they bid later on. And in that case, it wasn't nearly as cautious. And secondly, that compliance buyers, before they fill their entire compliance need, you know, they have a little bit of while to go. So I think that everyone was just kind of coming out of the woodwork this time around, dipping their toes in, if you will, and seeing if this thing was actually going to work, and where everyone else would come in and who would show up. So I'd say it's neither good nor bad. I think that the more important signal is that the volume for which buyers were bid it far exceeded the amount that was offered out there.
Okay, great. And Tim, I read in your blog last week that, you know, you felt that the, you know, pretty low clearing price was a good thing for Californians, and that it represented that there's really low-cost emissions reductions out there to be had. Could you talk a little bit about that?
Yeah, and I would say that seems to be, you know, because we've also done some analysis of the other folks that have been writing on this, you know, both news stories as well as analytical blogs and documents, and that does really seem to be a reoccurring theme, is that the low carbon price does seem to be a signal that the businesses may be viewing their compliance options as possibly less expensive than some have previously thought, which means that this program could achieve reductions possibly at prices lower than many have intimated, and that this could really search out and find the low-cost reductions, which is, of course, the point of the program, that and to inspire innovation and new opportunities for reducing emissions. I'd say also that other reasons that may be affecting the initial clearing price are that there may still be some uncertainty about the longevity of the program in some of the from some of the businesses that are out there, sort of taking more of a wait-and-see approach. But I think importantly, the demand for credits, as well as the fact that that there was purchase of the 2015 credits does show that that uncertainty is probably a little bit tamped down and maybe not necessarily as prevalent. The fact that there's no retirement of these credits until 2014, and that most of the credits the businesses have right now are already have already been given to them for free, means that there is the possibility of a lack of desire to really bid up prices at the outset and to really only go for a safe bet at the outset. And so I do think that it is a good signal. It's obviously something that will fluctuate over time. And there was a great quote by an investor, I think, in the San Jose Mercury News right after the auction, a gentleman named Rob Day from Black Coral Capital. And really he said, the price of carbon matters, but the price is going to change over time. It's really just more important to see that there's an appetite for the credits and that a price exists. And so that's really, I think, what this market and what the auction has created, a clear expectation that there is going to be a price moving forward and that there is going to be a return on investments that can reduce greenhouse gases.
Just to add, this is Dave Mann. An interesting paradox that we sometimes see with opponents of cap and trade is that they, at first, scream and moan that this is going to cost ratepayers so much money, and then once it does not, when you have a market near the floor like Reggie or a market near the floor like we are right now in California, and of course pricing coming off in the EU ETS, that it is now considered a failure because pricing was low. And I wholeheartedly agree with Tim that low prices, especially at the outset when you have opponents coming out of the woodwork, is a good thing.
That's a really good point, David. If I can just jump in as well, I just wanted to go back to this issue of uncertainty, because I think it's important to understand why there's an uncertainty and why it drives the price right now, and why it may not be a bad thing. There's two sources of uncertainty. One is that there is several lawsuits pending against the program, and maybe we can go back to that. Tim knows probably a little more. If some of those lawsuits are successful, it could change either the allocation or it could change the number of offsets in the system, and that would change the price. And so as a compliance entity, if I were to bid, I would be a little careful because I don't really know what supply and demand are right now if I think it's going to change. And the other source of uncertainty is actually the Air Resources Board itself. There are several aspects of the regulations that are still going to change, and CARB has said that would happen in the first half of 2013, and they've signaled what direction, what type of change they were considering, but they haven't given the details. And so once again, emitters are in a situation where they don't really exactly know what supply and demand are. And so it's not just, the longevity of the system is, as long as you don't know everything, then you really don't know what the equilibrium price should be. And even when you know the regulations, you don't necessarily know what the equilibrium price should be. But meanwhile, I think it just makes perfect sense that emitters and buyers would want to buy some of those allowances but keep the price low for now.
Great. Yeah, that's really very interesting. And we'll kind of see, how CARB decides to move forward after January. The next two questions might kind of turning back towards the market, and maybe David, I don't know if you saw this this question we received online about a spike immediately after the auction in the secondary market. But we got a question: what explains the price volatility in the secondary market, both in the long term and then immediately after the close of the auction? Did you see that spike, and what does it say about the the volatility in the secondary market, looking back to maybe in July when prices were approaching $20?
Well, I think volatility overall in the secondary market is mostly due to one, a lack of pure speculators in the space. There aren't too many who are getting involved, and we can get into that later. I think it's mostly due to uncertainty as far as the program's future. A second reason might just be the volumes that trade. Often you'll see someone like Point Carbon reporting that the price of allowances moves 10%, 15%, 20% over a span of 2 or 3 days, when really it was on lots of 5,000, 10,000, even 25,000, which might seem large when you compare it to the volume that trades often on ICE, but it's pretty small when you compare it to the program at large. So I think the volatility overall is, in summary, due to a small amount of players in the space, and then, of course, the small volumes that one can move a market around with. The other part of the question, as far as the volatility or spike immediately at the close of the auction did close or clear at 10:09, and then pricing was immediately in the mid-11s. I think that was a response to the bid volume being more than 3 times the amount of volume offered. So it ends up being a pretty good signal, as I mentioned in the and Tim mentioned as well in the prior question.
Okay, great. And then to continue on that, the last question we received online is the difference between those two prices of the auction clearing price and then the secondary market represent restrictions in the auction that aren't in the secondary market?
Somewhat. I mean, I've heard certainly complaints from some speculators and some compliance buyers as well that the auction is a little bit cumbersome. But at the same time, it's also a matter of large compliance buyers not necessarily showing their hands on the Intercontinental Exchange, which is the lead futures exchange right now for this product, and steering clear of that type of thing and moving more toward the auction. I think that you'll see speculators continue to rely on the futures exchange, and compliance buyers continue to rely on the auction. One of the main reasons, of course, is lawsuits and uncertainty. You have a large share of compliance buyers, of course, in this auction, and part of that might be due to the fact that they're the ones consigning, so the money goes back to them. Whereas if you're a speculator and you're bidding in the auction, you get these allowances and the program goes away, well, then that cash, as far as I know, is gone.
Yeah, that's very interesting. Maybe we can continue, the discussion about the lawsuits. Or
if I could just jump in here for a second, because I think Dave really hit on a key aspect. There are many that have said there's no surprises, and that was really based on the auction, that was a really good thing. But in speaking with brokers and marketers, I do think that there was one surprise, and that was that market participants were generally surprised by the fact that the full volume cleared and that it was 3 times oversubscribed. Dave said that, and I think that is something that really was a positive story that came out of this and the strength of the market. Second, and I think that was responsible for part of the immediate bump up in that secondary market credit. But one thing that we haven't said is that traditionally secondary markets that are trading are generally above auction settlement prices in a market like this. Basic finance incentives mean that when you're buying and holding allowances, for futures essentially, that costs money, and there's a cost of capital there that can be 5, 10, 20% of the value on a year-over-year basis. And so the secondary market prices in some way are pretty much going to be above the primary clearing price just because of the fact that it's a secondary market. And so I think we should not necessarily fully say that that's the cause of 100% of that increase, but it definitely is, I think, part of the factors that go into that price differential.
Okay, great. Yeah, I think and that hits some of the questions that I had out here about 97% of the bids coming from compliance entities. Does that kind of indicate that maybe traders or speculators were kind of sitting back? But I think the 3-to-1 ratio of bids really does demonstrate that the program is being taken seriously amongst the regulated sector. Maybe to shift tacks a little bit, we can talk a little bit about the politics. amid all the stories I was reading last week about how because there were no surprises, there weren't any glitches, that the program was a success, it cleared, and then I saw an article in the Sacramento Bee, saying that some of the folks that work on state budget issues were disappointed that the clearing price wasn't higher. Does this kind of present a double-edged sword for the state and for the Air Resources Board? I mean, I know that the goal for the Air Resources Board is to seek lowest cost emission reductions, which would support a lower price. But I know that the state would like some of those revenues. So, and any one of y'all can jump in on this.
Well, this is Tim, and it's of course important to note that this is just the first auction, and that I think between now and 2020, we're looking at roughly 32 more auctions, and many of those are going to be auctions that are going to be auctioning off credits for compliance entities that are not the utility credits, and so this is more opportunity, if that's what you want to call it, for that money to be taken in for the purposes of GHG emission reductions spent pursuant to the expenditure plan. And I do think that there was, based on the amount of sale and the projections by the governor's office, that there was some differential between what some had expected and what had actually occurred. But because of the moving back of the auction to November, and the fact that there weren't two compliance auctions in 2012, that it's not surprising that amount wasn't raised. And I think that there were some initial concerns over the original projections that said it was going to be very high. Folks like EDF and others in the environmental community said, don't expect that number that's actually taken in to be that high. And so, it's important, and the ARB has said it numerous times, that this program is not about raising money, and really what that money is for driving additional reductions and achieving additional benefits. And it's really the cap, which is the most important thing, and the auction and the money that may be taken in is a supplemental driver, an important supplemental driver, both for driving economic growth but also further emission reductions. And so to that point, I don't think that it's a disappointment, and I think that the folks in the state government are not necessarily seeing it as a disappointment. They're seeing it as a success. I know Matt Rodriguez, the Secretary of Cal EPA, came out immediately and said how impressed and how happy the state was with the auction. So I don't think that people are in the horseshoe reeling about how much money came in. Yeah, there's going to need to be revised budget projections, and of course in after the February auction and then after the other 3 auctions in 2013, there are going to be revised budgets. But clearly, this was not a failure with regard to how much money it brought in.
I didn't read the quote, and this is Dave. I didn't read the quote myself, but I almost feel as if somebody might have been speaking out of turn there with, of course the state would like to see revenues, but the stated goal is reductions, not necessarily revenues. So I'd be surprised to see if there was any fallout for that particular person. Did you note who it was?
I think we're referring to probably a couple news articles that characterized it as such.
Yeah, just to reinforce the point, the way the auction is designed is actually meant to minimize the price and minimize the cost, right? If the state was trying to raise as much money as possible, then everybody would pay what they bid for, and someone would be paying $91 for those allowances. And at the end of the day, there would be a lot more money to the state, but there also would be a lot more cost to ratepayers and to taxpayers in general. And that's not the goal. The other quick comment is this is a tension that you'll see each time you tax, I'm going to get nerdy here, but an externality in economics. So when you tax cigarettes, when you tax tobacco, it's the same thing. At the same, the goal is to reduce consumption, but at the same time, people kind of look forward to the money. And the discussion that are happening right now at the federal level of potentially including a carbon tax as part of a larger budget reform will very much run into the same issues of, oh, we're taxing carbon because that will help us make up for other lost revenue or avoid raising other taxes. But at the same time, if it works, then the revenues are going to be less than planned, and that's kind of the goal as well. So you're always going to have a little bit of that tension, but for the cap and trade program, the goal is clearly to reduce emissions, not to raise money.
Yeah, I think it's important not to confuse the priorities and remember what the goal of the program is. And maybe talking a little bit about the goal of the program, which is to reduce emissions. Tim, did you want to talk a little bit about kind of what this first auction tells us about the success of this program going forward and meeting the goals of AB 32 while still growing the economy?
Yeah, certainly. And I think that we've sort of hit on, of course, the key point there is that with the low prices, it does seem that at least at this point, there's a signal that this program may be cheaper than some expect, and that the emission reductions may be following in a cost-effective manner. The second part of that, of course, is that as we look to sort of what the future holds and the reduction of the cap over time, first, of course, with an expansion in 2015 and then a year-over-year reduction of 1% to 2% from there, is that I do think that the fact that there were 5.5 million allowances that were sold for use in the 2015 time period, and the fact that the state is then going to be auctioning off in 2013 in 4 separate auctions about 7 million tons of futures allowances in each of those, that this shows that, and if that trend holds true, that there's going, with the roughly 5.5 million allowances being purchased, that we're going to see a much higher percentages of those futures being bought on an auction-by-auction basis, which I do think sends a signal that as a long-term pathway, there is going to be businesses embedding into their decision-making 3, 4, 5 years out this program and its impact on their compliance strategies. And so for that, and speaking with numerous clean tech investors and businesses that are in the space of developing low carbon solutions and energy efficiency solutions, there is a significant bump, by this auction. When AB 32 passed in 2006, and since then, we've captured about $9 billion of clean tech investment in the state. And as milestones have been reached, there have been significant increases in the growth rate of that. First in 2008, and then again in 2010. And so with each step, as this cap and trade program has been developed, there has been significant acceleration of the investment and the growth of the economy, so much so that those businesses in California that are developing low carbon solutions have been growing 10 times faster than other businesses. And so I think it's a strong signal that economic development can occur, that we can decouple the growth of the economy from the growth of emissions, as the European Union system has shown can achieve. And I think that we can also do this in a way that improves residential ratepayers' bills, as a recent report from the Regional Greenhouse Gas Initiative found that has actually led to reduced bills across the northeastern region. And that is really a triple benefit of this program: grow our businesses, improve how much ratepayers and customers have to spend, reduce our expenditure on energy goods, and reduce our emissions at the same time.
Okay, great. Does anyone else want to jump in, or maybe I can move to some of the questions about some of the legal challenges? Okay, well, speaking of kind of maybe how, as some of you on the line may or may not know, on the eve of the auction, there was a challenge to the cap and trade regulation, and I wondered maybe if the folks on the panel, how do you think that might have affected the clearing price or the volume that we saw in the auction? I mean, obviously, lawsuits at this point, maybe nothing new to ARB. They seem to be fending them off. And I think, in my estimation, it seems to make the program a little bit more resilient, and that they've made a pretty strong regulation. But I'll just open it up to you all. Do you think that had a big impact on the clearing price and the volume?
This is Dave. I don't necessarily. I think that if that lawsuit were to go through on the side of the plaintiff, it would more affect how the money were spent as opposed to whether the program went through as a whole. I think something like a Commerce Clause challenge might have a whole lot more effect on the overall program. So you now have an offset lawsuit and a lawsuit as to whether this is a legal tax or an illegal tax rather. And in each case, the program would still be able to go through, albeit with some changes on the administrative side.
Yeah, I think the legal challenges, those that we know of and those that we hear of, because there's a lot of rumors going around on upcoming other challenges, including on the dormant commerce clause, as Dave just mentioned, are influencing certainly the engagement, how many people are active on the secondary market, and the fact that people are just taking it slowly, just waiting to see what happens in the next 6 to 8 months. We'll be in a very different place next summer when the rules are finalized, when the lawsuits have progressed enough that we have a sense whether any of them is a serious concern for the program. And until then, I think you're not going to see a lot of trading activity because people are holding off.
And this is Tim. I'll just jump in here. Is that I think that there has been general consensus that the lawsuit being filed on the eve of the auction was designed to have some impact, whether it was on the auction performance related to creating uncertainty, whether it was to color the commentary from the press, to change us from being a positive news story to something that is injected with negative influence. There's a number of reasons why someone may want to file a lawsuit in that manner. And I think that there's a blog from the Paul Hastings law firm that said, yeah, this may have created some uncertainty in the market, therefore depressing credit prices. But then the offsets lawsuit, to the extent that it was successful, if it invalidated offsets, that would increase credit prices. And so I think that there is this push-pull of uncertainty that's created by these lawsuits that can cause credit prices to fluctuate. But I think that in the end, people have been expecting lawsuits to be filed for a really long time now, upwards of a year since the program was first adopted by AIRB and approved by the Office of Administrative Law. And so I do think that some bidders have been already pricing in to their expectations of credit prices the fact that there may be lawsuits. Similarly how the stock market may be pricing in the fact that the fiscal cliff is coming or the EU bailout was happening, and that you have people that are pricing into their expectations of market performance, what may happen in the future. So I don't necessarily think that the lawsuit provided, and so I agree with Dave here, provided a significant moderation or change in the credit prices, but there was some probable impact. I think it's just impossible to quantify.
Okay, great. So maybe do one more of these discussion questions before we open up for questions of the audience. As far as the program design, it seems like the fact that there wasn't any surprises was really good news. And what does that say about any indication of fraud or market collusion? I know that there were a lot of discussion in the design of the program, and especially kind of lessons learned from the EU. Do you all have any thoughts on the issue of fraud or manipulation?
Yeah, this is Tim. First, I think a really good reference for the fraud and manipulation to try to understand what's in the program. UCLA School of Law put out a really great document called Rules of the Game a while back, and that provides a really good primer on the controls that are in the regulation. And I think with looking at, of course, the rules to participate in the auction, EDF actually participated in the practice auction, and so we're fully aware of all the rules and requirements to submit bids and to prove to the Air Resources Board who you are and what you say you're going to do is actually true. And the tight control of participation that exists, the fact that everybody we've spoken with, traders and brokerage experts, really feel that there's no evidence of collusion or illegal market manipulation, I think that's a very good sign. The fact that you also have the HHI index and the fact that 97% went to compliance entities means that there's a real diversity of ownership here. No one entity is holding a lot of credits in terms of percentage of the whole. And on that basis, I think that what you get is, and although some may have intimated that having just a really low carbon price in and of itself may be evidence that some people were colluding, I don't necessarily feel that that's true, and I think that that there's a strong basis to believe that there hasn't been at this point, fraud and manipulation. That and the fact that ARB has hired one of the world's best companies in detecting market issues. Market Analytics, who essentially runs the monitoring platform for the energy market in the Northeast, has looked at this, has evaluated it. That's their sole job here, and I think that there's a lot of comfort in knowing that all of those factors are working together to prevent fraud and manipulation.
Okay, great. Well, now I think it'd be a good time to open it up and then see what questions we've gotten online.
Dave, could I address one thing really quickly on the prior slide, if you'd flip back?
Sure.
It was there you go. It mentions at the bottom, what is the fact that 97% of bids came from compliance entities. I just went back to make sure, but the report from California doesn't say that. It says that the allowances purchased by compliance entities were 97%, and there's an important distinction there, because while 720,000 or so allowances went to speculators or non-compliance entities, it's impossible to say how many of the 50 million allowances that went, or 50 million allowances demand went unfilled between $10 and $10.09 was bid by non-compliance entities or speculators. So that would be an interesting number to know.
Sorry, to support your point, Dave, arguably speculators, such as they are, financial institutions looking to get into the market only for profit purposes would probably have been on the lower end of the range. And so it's quite possible that there might have been more bids from financial institutions in the lower part of the curve, the part that did not get successful in buying the allowances.
Absolutely. I'm definitely not saying that they were responsible for 49 million of the unfilled bids, but at the same time, I'd be really interested to see how much more than that 720,000 number was asked for between 10 and 10.09 by non-compliance entities.
Okay, great. All right, so I think now we'll try to take a few questions that we've gotten online. And the first one, and it seems to be we always get this question, will the slides be available? The answer to that is yes. We've also going to be making a recording of the webinar available on our website, and that will be www.climateactionreserve.org/resources/presentations, and I'll send that link out to the group here. As far as a little bit more insightful questions, any insight into how the auction results will influence ARB's adoption of additional compliance offset protocols? I will let anyone who wants to jump in on that one take that one, since I might be a biased responder to that one.
My initial response to this would be no, not right now, and maybe in a way that's what I recommend, but it's feeding off each other, right? Prices are low because people expect more offset protocols, because CARB has said more offset protocols were coming, and there's been forecasts out there in terms of how much volume that will bring to the market. So then if CARB turns around and said, oh, but prices are low, so we don't need those offset protocol anymore, then prices are going to go up high, and then you can see how that can keep going for a while. So I think the regulators' interest is to be really consistent in the signals that they send and follow through with regulations where they say they were going to do that. And if that means prices are low, well, again, that's the goal of the program in a way, as long as the reductions are there.
Okay, great. Thanks a lot, Emily. I've got another question talking about the mean price of $13.75. Does the mean bid price of $13.75 hint that buyers were prepared to pay more than the $10.09 for allowances?
It certainly does. I mean, the fact that there was a bid of over $90 means that someone was willing to pay more than the $10.09, as Emily explained earlier. The way that the auction works is that they clear allowances until they hit their maximum volume, and the price at which the bottom price at which that volume is cleared is the price for everyone. A point was brought up to me by a client a little while back that some of the compliance entities, those that were consigning allowances, would have been content to pay a good amount more than the clearing price, simply because they would be seeing the money fall back into their coffers as a result. As was mentioned earlier, the way the consignment works is the allowances are put out by the sellers by law, and they can then buy them back at the same price. So it would have been a wash for them even if it were to clear for $23 or $91.
So if I can also just jump in here, Severin Bornstein from University of California, Berkeley, their Energy Institute, wrote a really interesting post where he talked about the median and the mean prices, and found that there was an issue associated with how it was reported. And in a clarification by the Air Resources Board was issued and said that the median price was actually for all the bids that were submitted, including the ones that were rejected because they exceeded procurement limits or holding limits for the market participant or failed to meet the requirements for bid collateral. But the distribution in the bid price summary statistics and the market clearing price reflect only the bids that were not rejected. And so there's a difference in comparing apples to apples when you're looking at the mean and median versus the accepted the clearing price. And so I haven't read fully into how that difference equates to the answer to this question, but I think it's important commentary. Second is, I would say that the person that bid $91.13 was probably fully aware that they were never going to have to pay that amount, and so they could have bid $100, they could have bid $1,000, and I would even go so far as to say that number, $91.13, is important to someone, like their kid was born on September 11th, or their dog ate 91 dog biscuits, and so it's like there's some reason why somebody bid that number, and there's absolutely zero expectation. You talk to anybody in the market, with 99.999% certainty that they were never going to have to pay that value, and so it's really an irrelevant number because, of course, then you have the alternative auction that could happen 6 weeks later if you have a clearing price that's above a certain amount. And so I don't think necessarily that we should read too much into that $91. And yes, the bid was accepted and it was cleared at $10.09. But that really doesn't mean much for that $91 number.
It doesn't skew the price upward because it's volumetric, right?
That's right.
Yeah. Okay, I've got another question talking about volume of allowances. Will the volume of allowances offered for sale in 2013 auctions, I believe the next one's coming up in February, will the volume change versus the volumes that were put on offer in this past auction?
Yes, this auction was actually almost a double auction. Originally, the Air Resources Board was going to have an auction on August 15th and one on November 14th. And then the one in August was canceled, and a lot of the volume was rolled over. So the auctions in the next year will probably have lower volumes, although we don't have the numbers yet.
Okay, great. I've got a question coming about Quebec and the prospects of a joint auction with Quebec, assuming the state moves forward with the Western Climate Initiative and linkage with the province of Quebec in 2013. What are your all's thoughts on a joint auction?
I'll jump in here. I think that over time, the Air Resources Board has been developing this program at the same time that they're consulting and having active conversations with Quebec. The Quebec program, has been written and is available on their website and is nearly identical to the Air Resources Board program, with some slight differences, but with 95% or maybe even greater commonality. And that's really a testament to the WCI principles and the work that's gone into that process. Now, whether that translates into joint auctions in 2013, I think ARB has said that they would like to see that happen. We, of course, do know that with the more recent bills that have been passed in the state legislature, there needs to be findings by the governor's office of equivalency with regard to environmental stringency, and that's really important to making sure that we protect the California program as we expand it to allow other or trading or exchange between other programs. So I think at this point, there has been focus on getting this auction done, and so there hasn't been a significant amount of external outreach to stakeholders to ask for their input on the Quebec work. But we do know that they're working right now to come to a resolution with Quebec and have more conversations about whether a 2013 push is going to happen. And I don't think it's off the table by any means.
Okay, and Emily, were you going to jump in on that? I thought I heard you.
No, I totally agree with you.
Okay, great. So I've actually got a question, a little bit, maybe to step back a little bit and give some context and a little bit more basic level of understanding of what is meant by the secondary market. And maybe, I don't know, Dave, maybe you can talk a little bit about what the secondary market's function is.
The primary market is the market between the large initial seller, and the secondary market is all the trading between the large initial seller. In this case, it would be the government. In the case of, say, project offsets or renewable energy certificates, it's the market between the project owner and the end user. The secondary market is everything that goes on in between.
Okay, great. And then a follow-up question. Do you think the secondary market can be relied on to identify allowance prices that would minimize the costs of meeting the cap more than, I guess, the primary market?
I think it depends on what volume you have in each market. In California right now, I think the price signal from the primary market means a lot more than the price signal in the secondary market, just because there's so little volumes, as Dave pointed out earlier, in the secondary market. In Europe, until recently, but still now, it was certainly the opposite. Most of the allowances were traded on the secondary market. The primary market was tiny, and because it was a large, liquid secondary market, the price signal meant and still means a lot in terms of what the cost of complying with the program are.
Okay, great. And I think we have time for maybe one more question, and why not end it on maybe a political question here. I've got a question coming in that says, will the results of the auction decrease the effectiveness of lobbying efforts by some emitters for more free allocations of allowances to be made available to prevent their costs from spiraling? And anyone's free to weigh in on that one.
I think even at the price floor, there or close there too, major emitters that are now having to price in the cost of emitting greenhouse gases and that aren't getting 100% of those allowances for free. I think that we're going to continue to see efforts to try to put a stop to this. I think it's important to note that economists, nationally respected economists, back in October submitted a letter, with 55 different signatures of PhD economists saying that the auction component, while of course not the fundamental driver for reducing emissions, because that is of course the declining cap overall, is tremendously important to protecting the integrity of this program. And so while we may still see efforts, lobbying efforts to try to put a stop to the auction or to color the commentary about the success of it, I do think that there will continue to be those that have been studying, focusing, implementing this for even majority of their careers in some instances to protecting the auction component and really preventing California consumers from having to pay for the value of this program and letting those businesses that otherwise would have to embed in the cost of this program into the decision making. They don't just get to pass it through and keep all the profits. And that's really sort of what this is about. It's about equity. It's about creating additional opportunities to reduce emissions. And so I think that there's going to be competing interests on both sides moving forward.
Okay, well, great. Well, I think we've reached the conclusion of the webinar. It's just about 11 o'clock. To finish things off, I've got contact information for each of our panelists, and I'm sure I will join everyone on the line in thanking you all for some really great feedback and for your participation this morning or afternoon if you're on the East Coast. Thanks to everyone who joined us online. I think it's been really great. So thanks a lot, and stay tuned for the next webinar.
Thank you, Scott.
Thank you, Scott. Thanks, everybody.